Trump might actually push your mortgage rate down. Without touching the Fed, without Congress, just by messing with one line on a government spreadsheet. Yeah, one policy tweak, and 30-year mortgages could drop by a full percentage point. That's not Twitter drama. That's save six figures over the life of your loan drama. Let's break down how this works, what it means for your house, your stocks, and why this one quiet move could slam the whole economy into a new phase. So, here's the setup. Most U.S. mortgages don't just sit on your bank's balance sheet. They get bundled into mortgage-backed securities guaranteed by Fannie Mae and Freddie Mac. Those guarantees aren't free. There's a built-in guarantee fee, usually around 0.5% to 0.75%, that gets baked into your mortgage rate. If the government cuts that fee, your mortgage rate can drop, even if the Fed does absolutely nothing. Trump's team is openly pushing for exactly that. Lower guarantee fees and looser rules at Fannie and Freddie to unlock housing. Here's where things get interesting because that guarantee fee shows up as part of your final rate. Say the market says 6.5%, but the fee effect is 0.7%. If they slash part of that, you might see offers at 5.8% instead of 6.5%, without any headline Fed rate cut at all. Now zoom out. If 30-year rates fall from the 7% zone toward the 5s, a lot of people who've been frozen out of the housing market suddenly qualify. Demand jumps. Construction companies wake up. Home builders, REITs, banks, all feel that pulse. And here's where things take a step further. Because this isn't just, yay, cheaper houses. It's a political move, a banking move, and a risk move. Lower guarantee fees mean Fannie and Freddie earn less per loan for taking on credit risk. If that risk is mispriced, taxpayers quietly become the backstop if things go sideways. Now, quick reminder, none of this is financial advice. I'm not your advisor. I'm just the guy who watched his parents lose most of their savings because they trusted a bank brochure more than a calculator. Do your own homework, talk to a pro before you act on any of this. Let's hit the key takeaways. First, easing mortgage rules and cutting fees is basically a stealth stimulus. It doesn't show up as money printer go brr, but it makes credit cheaper for a specific group, home buyers. Second, this tilts the playing field. If you already own a house at a low rate, you might see your home price rise again. If you're renting, you might see prices run away. Again. But then the unbelievable thing happened. The same crowd that spent years complaining about risky lending is now flirting with going right back toward easier credit, just branded as affordability. We've seen that movie. The sequel usually has worse CGI but the same plot. Third, banks and mortgage originators love this. Lower rates plus easier guidelines usually mean more volume, more refinances, more purchases, more fees. On Wall Street, housing recovery instantly gets translated into earnings growth, loan growth, and our stock-based comp still goes up. And if you're an investor tracking this, here's the twist. Lower mortgage rates don't just hit housing stocks. They ripple into consumer spending. People with smaller mortgage payments have more cash for everything else. Inflation. More demand for houses and goods can push prices back up, which then pressures the Fed again. Tech and AI. Lower long-term rates generally boost growth stock valuations. Discounted cash flow math suddenly looks a lot friendlier when the discount rate falls. But it's even getting worse because if policy forces mortgage rates down while inflation is still sticky, you're basically stepping on the gas and the brake at the same time. On one side, the Fed is trying to cool things off. On the other, housing policy is yelling, "Send it." Here's the risk that no one puts in the campaign clip. If you juice housing too much, you don't just make homes more affordable. You can trigger another price spike. The new buyers get in at lower rates but at higher prices. If the cycle turns, they're the ones stuck. When I was 12, my parents trusted a bank advisor who told them, "Don't worry, housing always comes back." Technically true, eventually. Emotionally brutal in the meantime. That's why I'm allergic to anything that smells like, "Don't worry, the government will make it safe." Now, what should you actually watch next? Number 1, Any move to cut Fannie and Freddie, guarantee fees, or loosen their capital rules. That's the boring line in a press release that will matter more to your life than half the viral headlines you see in a week. Here's where things get interesting. Number 2, how the bond market reacts. If investors think this adds risk, they'll demand higher yields for mortgage bonds. That can eat into the rate drop you thought you were getting. It's not magic. It's a tug of war. Number 3, what the Fed does in response. If mortgage rates fall sharply and housing takes off, the Fed might hold general rates higher for longer. That means cheap mortgages for some, but still expensive credit cards and business loans for others. And here's the wild part. This is all about data and narrative. When I worked at a local newspaper in college, I watched the same economic story get spun into 2 totally different headlines. That's happening again now. One side will call this fixing housing. The other will call it re-inflating a bubble. The truth will be somewhere in the fine print. But then he said this unbelievable thing, because whenever a politician starts promising easier credit, you should mentally translate it as, we're moving risk, not deleting it. If that risk ends up on the taxpayer, on future buyers, or on pension funds holding those mortgage bonds, someone will pay for today's affordability tomorrow. Now, quick break, because if you're watching this thinking, I'd love to talk about this stuff on my own channel, but I don't want to be on camera. There's actually a way. This video was created with Fludge.io, the same system that powers this entire channel. If you're like, I want a YouTube channel, but I have a job, a life, and zero interest in learning editing software, that's exactly what it's for. Fludge researches topics, writes the script, makes the thumbnail, uses an AI avatar, and uploads the video automatically. You stay in control, step in where you want, and over time it learns your style. So if you want a channel without burning out or turning into a full-time editor, check out Fludge.io. And here's where things take a step further. Let's talk about what this means for you in practical terms. If you already own a home at a high rate, watch for a real refinancing window, not just headline noise. A drop of 1 full percentage point can be life-changing over 30 years. If you're trying to buy, lower rates might help, but don't just chase the payment. If prices rip higher again, you can still end up stretched. Run the numbers like you're the only adult in the room, because you might be. If you're an investor, this is one of those moments where boring beats hype. The day they tweak guarantee fees won't feel dramatic, but the next 12 to 24 months of housing data, bank earnings, and consumer spending could all trace back to it. That's the kind of thing I leaned into in my 30s. Boring, unfashionable, but actually effective. It wasn't sexy. It just worked. But it's even getting worse, because if we get this wrong, we don't just get a little wobble. We get another strategic realignment era where regular people lose jobs, houses, or savings, while the people who wrote the policy get a book deal and a consulting gig. I've lived through one of those corporate realignments. The press release sounded brilliant. The layoffs were not. So let's wrap this up. Trump pushing to force mortgage rates down through Fannie and Freddie is a big deal. It can lower your payment, boost housing and certain stocks, increase risk somewhere else in the system. Your job is to track where that risk actually goes, not just the headline about cheaper mortgages. If you found this breakdown useful, hit subscribe to the comment section with Thomas Paul. Drop a comment. Do you see this as smart housing relief or just the prequel to the next bubble? I read the comments, I learned from them, and I'll see you in the next one.